And so welcome to our session on investment consultants, and it's titled The Final Frontier for Responsible Investment. Investment consultants advise on trillions of dollars of assets. For many asset owners, they are their primary point of contact for the investment chain. For some asset owners, they're their only point of contact with the investment chain. Investment consultants are trusted advisors. And so the views that investment consultants hold on sustainability, on environmental, social, and governance issues have profound implications for the sustainability of the financial system. And PRI research finds that in too many cases, consultant and client simply don't discuss ESG. And we identify barriers and solutions in three areas: in policy and regulation, in market structure, and in industry practice. And the way this session is going to work, and the reason why I'm standing here, is that we've got three case studies that we want to share with you today. Case studies that identify those barriers and begin to present some of the solutions. So first, on policy and regulation. Investment consultant advice in nearly every market is unregulated. The content of the advice is unregulated. For asset owners, ESG requirements are often unclear, poorly drafted. There's little oversight and poor implementation. Asset owners and asset consultants are also struggling with a tsunami of regulation that asset owners now face. It means that ESG gets pushed down the list. And so our first case study is going to look at the role of the consultant and the lawyer in helping their clients understand the ESG regulation and understand how consultant and lawyer can work together to support their clients fully integrate ESG. We also found barriers and solutions across market practice, market structure, I should say. And so we have, in most markets, a fragmented pension fund structure where pension funds often don't have the resources, and they're often small and constrained, against a highly concentrated asset consultant market in which switching rates are low, and asset owners do not want to work, often do not want to work with a consultant that doesn't have a comprehensive view of the market. One of the things that we found was that asset managers are rarely communicating their ESG capabilities to the asset consultant, and the asset consultant then is rarely communicating that to the asset owner. So our second case study is going to be with PIMCO and Aon, and it's going to look at how asset managers can best convey their ESG capabilities and how asset consultants can rate that. And then our third set of barriers and solutions was in industry practice. We found that consultants often don't have a good awareness of ESG issues beyond listed equity. We found that there are centers of excellence within consultants, but often the field consultants, the people responsible for the client relationships, are unaware of that. And we found very little evidence of consultants fully integrating ESG issues in asset allocation models. And so our third case study is going to be with Mercer and CalSTRS and look at how they are making progress in integrating ESG in asset allocation. Our objective is actually very simple. We simply want ESG issues to be integrated in the full service delivery of consultants. We want them to be having conversations with their clients on ESG issues, even when they perceive it unpopular to do so. And so with that, I'm going to invite our first case study. So Daniel and Craig, if you would mind standing up and joining me here. Daniel, I'm going to turn first to you, and I'm going to ask you if you could briefly just introduce yourself, the consultant that you work for. And then we'd like to start with the work that you and Morgan Lewis and Craig representing Morgan Lewis have done on helping your clients understand ESG regulation here in the US. Daniel.
Yeah, absolutely. Thank you very much. Great introduction, Will, and I'm really pleased that PRI have begun to look at the work of consultants, having come from the other side, as it were, working in-house in an asset owner, a BT pension scheme in London for a number of years. I spent, as I know many of you have, a fair amount of time bashing the consultants for not doing enough. So now I'm on the other side. It feels good to be presenting this particular view on behalf of Wilshire Consulting that advises a number of particularly US retirement plans, endowments, and foundations. And I've come into this role to help kind of bring ESG to the forefront of our investment advice in a more sort of holistic way. And so really that kind of brings me to this discussion around working really in a more coordinated way amongst advisors. And I've learned my lesson the hard way around this. In previous roles, and I should have seen this coming, trustees often do ask, where does the sort of ESG, SRI impact discussion fall within my realms of fiduciary duty? It's certainly kind of the top 3 most frequently asked question that I have when I go around speaking to trustees. And I should have seen this coming in 2014. I was presenting to a group of British trustees. The UK Law Commission there, Will and others at PRI are very familiar with this, actually published some guidance on fiduciary duty for investment intermediaries. And I felt that it was actually very helpful clarity and guidance around being clear around the differences between SRI and exclusions, ESG integration, and impact investing. And so I put forward this view, this interpretation, and one of the trustees said, okay, well, it's very well you think that. What does the lawyer think? And the lawyer came in and talked for 45 minutes about a piece of case law from 1985, which some of you in the UK are familiar with, called Cowan and Scargill, where the trustees of a coal company decided to effectively divest the scheme's investment holdings from competing commodities to coal in order to protect and shore up and strengthen the sponsor there. So clearly, given all these discussions around environment and climate change, it's slightly ironic that it was a coal pension fund going through this discussion. But the point was, when the lawyer came in, it kind of derailed the conversation completely. And so I learned the lesson the hard way to really try and iron out some of these discussions around terminology before presenting an investment thesis and a strategy to a group of trustees. And so when the field assistance bulletin issued by Department of Labour caught us completely by surprise, as I think it did for many others, the first thing I did, I think, was sort of what any sensible consultant would do, particularly having learned what I've learned, is to call the lawyers in. And so we got together with Morgan Lewis and hosted a webinar around trying to help our clients better understand what this update to the ERISA guidance means for trustees who were just beginning their journey. Does it mean that we can look to this guidance and say, there you go, ERISA says no? Or actually, is this reaffirming the need for trustees to undergo a thorough analytical process in order to understand the costs and benefits of integrating ESG into the investment process? So I'll bring in Craig into the discussion here, and we might have a little replay of some of this discussion around consultants and lawyers, particularly with the ERISA discussion.
Yeah. So let me introduce myself quickly. I'm Craig Bitman. I'm the head of the employee benefits practice at Morgan Lewis. And I'd like to thank Will for not naming this "It's all the lawyer's fault," although it sounds like, Daniel, you might want to name it that. We've been working with a number of clients and with Wilshire and other consultants on implementing ESG policies, especially after the field assistance bulletin came out. And quite honestly, more importantly, is any type of event trigger that comes along tends to be what leads our clients and leads us to our clients to think about these issues. So earlier this year, we saw an enormous uprise from our clients in asking questions about ESG investing after the Parkland shootings. And any events like that tend to really spark the discussion and spark participant interest and having pension participants or other stakeholders coming to the plan sponsors, asking them for their policies on social investing, on ESG investing, or how they can actually better comply with these intentions. And so we've worked with consultants, and as Daniel was mentioning, ERISA is very much a process-driven statute, and this is the statute that governs private pension plans in the U.S. Public plans are subject to various state rules that are similar in nature to ERISA, but all of them tend to really hit on what is the process by which the fiduciaries made their investment decisions, and did they go through a diligent process in deciding whether or not ESG factors should be taken into account. And that's what the DOL's Field Assistance Bulletin gets into. For those of you who don't know, and just a very, very brief background, the Department of Labor has issued over the past 20 years kind of flip-flopping guidance on social investing. And let's refer to that as economically targeted investments and social investing, where the general rule that they start with is that you can take into account outside interest beyond investment return if all other things are equal. And all other things equal is where they kind of flip-flop over the years. And under the Clinton administration, under the Obama administration, that's a more lax standard. And then under the Bush administration, they went back the other way and were really put the clamp down on what it means to be all other things being equal. The Field Assistance Bulletin that came out from the Trump administration is a little bit different than the prior guidance. First of all, it's a Field Assistance Bulletin, and Daniel and I were talking, it just doesn't have the same impact as the interpretive bulletins that the prior guidance have had. A Field Assistance Bulletin really does not have the weight of law. It will generally not be given the deference that the regulations are given. And so while some people think that it's really a pullback of prior guidance, it's really not. It doesn't have the same effect. Second, that the guidance that came out, the Field Assistance Bulletin, actually for the first time specifically addressed defined contribution plans, which is where we've seen a huge shift in obviously dollars, but also in interest by participants. And under the Field Assistance Bulletin, while they had some cautionary guidance on the default investments in defined contribution plans, at least if the offering is additive to the investment lineup, but actually the Field Assistance Bulletin kind of gave some guidance on that and said it would be okay as long as it's otherwise prudent. So we've seen a lot of interest and have been working with the consultants to kind of play out that procedural prudence and try to get these investments into investment lineups.
And so I'd like to ask one more question, if I can, moving a little bit beyond regulation. That's about the leadership that you as consultant and lawyer can provide to clients if they are new to ESG. And so can you just talk us through how you are working together in order to provide that leadership to give your clients the comfort that ESG issues are very much part of a prudent investment decision?
Yeah, why don't I have a go at that? I mean, the theme that I'm trying to talk about is the need for sort of coordinated and sort of consistent advice in this space from consultants, from managers, from data vendors, from legal counsel to trustees, in order to sort of clean up, dispel some of these myths that we know are extremely pervasive in the marketplace around ESG impacting, negatively impacting investment returns, for example. So, I think very much what consultants and other advisors perhaps are grappling with is this kind of proactivity. Some of this sort of lies, I think, with the question of kind of the fiduciary obligation in terms of, if quite often our response has been, well, tell me what you want to either not own or own, and we'll optimize a portfolio accordingly, or we will update your investment policy statement accordingly. But I think we're moving away from that in order to very much fill this need for a process. And so we're now proactively coming along to clients and saying, here are the costs and benefits of the different approaches on this spectrum that we talk about, and helping the client very much understand if they were to, for example, exclude the coal industry from their portfolio, not only kind of at a total portfolio level what the impact would be, but then also help them through some of the implementation methodology. So it's really kind of not getting overly theoretical, but how could you implement this in practice? Because we know that a lot of particularly US asset owners have had some level of education, certainly according to our survey. They have some grasp of these concepts. They've maybe thought about ESG in terms of policy, but they've done very little in terms of implementation. And so I think our job when we're educating is consistently and in a coordinated way tie up these theoretical discussions around costs and benefits with portfolio implementation.
And then I think when we work with the consultants, one of the things that I think we bring to this on a proactive basis is really alerting the client to potential legal risk. Some clients are more risk averse than others, and if you're thinking about where potential litigation may fall, regardless of what the DOL says is consistent or inconsistent with your fiduciary duties, at the end of the day, what's probably most important is what you're going to do a litigation risk to the fiduciaries. So if you think about for instance, a defined benefit context in the United States, there's pretty substantial case law out there saying that if a participant is getting the benefit that they're otherwise entitled to, can you really even have much of a breach of fiduciary duty by the fiduciaries of that defined benefit plan? Now, it's a relatively risky proposition to say that, but there is certainly case law that says that if you haven't lost anything, you have no standing to bring a suit. And so, the idea of a board or trustees implementing in a defined benefit context an ESG strategy, to me, seems like a much lower risk proposition. And then when you have the guidance from the FAB on defined contribution plans, which really seems to open the door for defined contribution plans to at least start thinking about these issues, it seems to me that the consultants and the lawyers working together can proactively assess how to go about implementing ESG, and then also how to mitigate that risk.
Yeah, and I think that the one aspect of that we haven't really talked about is the concept of prudence. And I think if you take away anything from listening to Al Gore and his Rudy Dornbush quote around things take longer to happen than you think they will, and then they happen faster than you ever thought they could, we certainly are presenting ESG as a prudent approach, certainly to be considering these risks sooner rather than later.
Okay, thank you. We're out of time for this case study, so I'm going to ask you to sit down and ask our next case study to join me, please. And I think from PRI's perspective, the challenge that we've got is to work with consultant and lawyer to move from a permissible around ESG to a requirement. It's no longer you can, but you must. Now, a second case study, very pleased to have representatives from Aon and PIMCO, from Meredith and Scott here to join us. And I asked Meredith to speak because Aon have just begun to fully implement ESG issues in the ratings, or providing ESG ratings to their clients. So Meredith, would you mind please introducing yourself and then telling us a little bit about that process that you've been through, and then it would be very interesting to hear the asset managers' reflections on that.
So first of all, thank you all for staying so late. I guess I can give you probably the best bit of hope, even more than what Al Gore gave everyone in his rousing speech, for the future of ESG and the environment. And that is the fact that someone with my accent is heading up ESG and responsible investing within a major consulting group. So liberal rednecks may actually rise and save us all. So I've been in the investment industry for about 20 years. I've been focused on diversity and ESG investing for a number of those years. And one of the things that I was hired to do at Aon was actually to expand our responsible investment practices. And one of the first things we wanted to do was to offer our clients a way of comparing managers based on ESG integration. And so earlier this year, we actually introduced discrete ESG ratings. They are separate from our strategy and our buy ratings. so that clients who really care about ESG can get granular information on their managers. But at the same time, for clients who may not be quite up that curve, it doesn't penalize the managers who may be at the beginning stages for not having implemented as much as maybe they could have. When we first started this, we had a number of people in the firm who had brilliant ideas on how we could rate managers. I had people skid into my office like Kramer on Seinfeld on a number of different occasions with their brilliant plan of how we were going to rate managers. Some of my personal favorites were, can't we just send out a checklist? No. And can't we just look at their portfolio and see what they're holding and just make a guess? Again, no. And so what we came up with was that we really had to have a granular system, because a checklist, for example, asking a manager, do you have an ESG or responsible investment policy? The answer could be yes, but then when you start to look at that policy, it can be everything from we consider ESG in our investment decision making to a 20-page policy that includes very granular information about the policy, who executes on it, who has the right to overrule, what the voting and proxy voting and stewardship is, and all of that kind of good stuff. We also can look at the portfolio, because managers who don't do ESG or responsible investing could luck into a portfolio and get a high rating, and then if we looked at the same portfolio a month later, they might not have the same holdings, and it may be a completely different picture. So one of the things we did was we developed an ESG questionnaire, and that questionnaire focuses on 3 main areas, and I'm going to talk to Scott about how his firm implements this and what kind of information they share, because these are the things that we've decided are really critical for us to be able to get a handle on ESG. And the first one is specificity. So we do ask people if they have an ESG policy, but we want to see that policy, and we want to see the specifics of that policy. Because what we found is that managers that don't have a very specific policy spelling out who does what to whom at any given time likely are perhaps using ESG as a greenwashing or a marketing technique. So Scott, if you can talk a little bit about PIMCO and what type of information you disclose in your responsible investment or ESG policy that lets people get that granular data, that would be great.
Yeah, happy to do that. So we took the approach of basically saying ESG is, we're going to completely integrate it into the process. So for instance, every credit we invest in, whether it's corporate or sovereign or securitized, we have a score with respect to E, S, and G, an internal score. So that makes it pretty easy in a lot of ways for us to share our views on a particular sector. But we haven't taken the one-size-fits-all approach, so we're not saying it's the same answer for every portfolio. I mean, we think that's pretty important. I mean, people have all sorts of different objectives they're trying to achieve. Some have a high degree of sensitivity to E, S, or G in different weights, and some have much lower. So what we have is sort of a platform approach where we can say, well, let us understand your objectives, understand the benchmark, and then we'll share with you what we think is most relevant in that area. And so, I mean, we applaud the work you're doing in sort of grading managers on their ability to deliver that. It's really evaluating the process and what managers can deliver in that area. It's definitely not a one-size-fits-all approach where you can just go down and say, well, here's our score, so we only invest in this. I mean, I take issue with that. I encourage people to think about ESG and sustainable investing a lot like you would think about investing in typical corporate credit. Someone could be a corporate credit investor. They're investors who invest in CCCs, and that's their target, and those who invest in AAAs. Well, when it comes to sustainability, you want the ability to evaluate those factors, whether you're investing in CCCs or AAAs. And so it's important for us to have the capability to really customize a solution for a client, work with a consultant to do that.
So one of the key things is that he's actually disclosing the information. One of my favorite managers that we rated not too long ago, we asked them if they had an ESG policy or responsible investment policy. They said yes. We said, can we see it? And they said no, which starts to make you wonder if it actually exists or not. The other thing that we've noticed is that sometimes we get these very specific policies from people and these very detailed and granular answers to the questions that we're asking. But then when it comes down to it and we start asking for examples, which is the second pillar in the type of information that we're gathering to get a really good ESG rating, they're not able to give any examples. Or my other favorite, all of their examples have to do with governance. So instead of it being E, S, and G, environmental, social, and governance, it's actually ESG, every single governance issue. And so we spend a lot of time going over examples of things like, can you give an example where an ESG characteristic may have prevented you from investing in something? Can you give an example where ESG may have made an investment more appealing? Can you give an example where ESG made you decide to sell something at a particular time? Because once you start to get that, then you know, you have a better idea who's just putting together a policy so that they can send it out to investors and who's actually eating their own cooking. And so, Scott, can you talk about maybe a specific example of some where ESG has impacted some of the investment decisions in your one of your portfolios, I should say? Right.
There's a, you know, since our approach is to really rate every issuer relative to their peer group, it's pretty easy for us to go in and say, well, you know, for a client that's sensitive, particularly to sustainability issues, you know, we can really bias the portfolio and show them how that stacks up. But obviously, in the in the energy sector, in the utility space, tremendous differences between companies with respect to their plans for energy transition, how they're dealing with those risks, how they're thinking about their business model. And so there, you know, it's an easy example to go in and show, okay, there are leaders in the field, those who really, you know, have a well thought out plan for that transition, and those that aren't. And that heavily influences our decision about which of those credits to put in a portfolio. Another one, you know, looking at, for instance, financials, obviously a big sector, but you know, tremendous difference in conduct, culture, and sensitivity with respect to social issues and how financials are investing, you know, how they're looking at their portfolio, and where they're trying to grow their business. And so, you know, that's an important factor when we go in and look at the whole financial space, an area where we tend to be overweight at the moment. Big differences, and you can, without naming names, I mean, I'm sure you could think of some big differences just reading the headlines in the newspaper and realizing there's some major differences there. So those are examples. When you get into things like municipals, municipal credit, big differences there in terms of, you know, what types of projects you're funding and how different municipals are dealing with those issues, and do they have themselves a policy with respect to sustainability. And so once again, you know, you can have a wide spectrum of ratings. Now, you know, it gets back to this issue. I mean, we're big consumers of all the external data, and it's good. There's so much external data coming out from Bloomberg and MSCI and Sustainalytics and so many others, but it's not internally consistent. So our approach has been to say, yes, be big consumers of that. We can speak all those languages and help people understand why we might be different. But that's a big part of the process too, is going and just being able to explain to people, well, this is the portfolio we would put together for you. Here are the reasons why. And it looks a little bit different than maybe, you know, if you scored on MSCI, maybe it's a little bit different than Sustainalytics, et cetera, but here's why. So that's an important, I think, element of our approach that's different.
And just so you guys know, if this was actually an ESG rating call that we were having, I would be tasing him to make him give me specific names, as opposed to letting him talk sectors. You know, there might be a swinging light bulb over his head until he gives me things. I'm not going to do that to you in front of 200 of your closest friends and peers, but obviously it's an important part of the process. The last
1 minute for the third bit.
Gotcha. The last thing we talk about with managers is the whole issue around active ownership and stewardship. Again, we're looking for detailed policies. We're looking for very specific examples. Just saying that you vote against management isn't enough. You have to be able to say when you have voted against management, and it has to be in both all three categories. So, Scott, one of the things people struggle with is the whole concept of active ownership and fixed income. Can you talk about how PIMCO deals with that in 30 seconds?
Yeah, tremendous opportunity in fixed income. It's been overlooked for too long, but you know, we stress that certainly fixed income investors have a big role to play. They can be very influential in influencing companies because fixed income is unique. The issuers come back time and time again. They constantly care about the ratings from traditional rating agencies, as well as increasingly those people rating them with respect to sustainability criteria. So they care. And if you're a large asset manager or an asset owner, you have tremendous ability to influence them through your discussion and research with them as they come to market on a routine basis.
So the last thing I'm going to say is, just so you know, there is no one size fits all here. There doesn't have people don't all have to follow the PIMCO model, although it is a good model. But we're just looking for things that work within the construct of a fund management firm. It's not that it has to be integrated or not integrated. We're just looking for things that work. And in order to do that, at this point in time, we feel like you have to have a lot of information and you have to have a human involved.
Great, thank you. And if I can just add from PRI's perspective, the position that we want to get to is where consultants are not putting fund choices or fund options in front of their clients because of poor ESG scores, or if they are rating asset managers and they're not able to fill the due diligence questions on ESG, then that fund is not part of their platform. And that decision being made by field consultants that might not necessarily have that ESG specialism. I'd like to move on to our third case study now, and we think this is absolutely fundamental in terms of moving markets, is getting ESG to be a completely integrated part of the asset allocation process. So I'm going to invite Helga and Brian to join me up here too. Mercer has been thinking about this for some time now. They've begun to develop tools that help their clients to understand how to integrate sustainability in the asset allocation process. Helga, can you just introduce yourself, your firm, and just tell us a little bit about that tool, please?
Thank you, Will. Hi, everybody. I'm Helga Birgden. I'm the global business leader of Mercer's responsible investment team. And this is my colleague. Brian, would you like to?
Hello, yes. Brian Rice from CalSTRS. I suppose at this point in the conference, there's enough speakers from CalSTRS that you're familiar with who we are, but we're the pension plan for California's public school teachers, headquartered in West Sacramento.
Yes, great, thank you.
So this tool, a number of our signatories are beginning to think about ESG in asset allocation. In our research, we were unable to find many examples of where consultants were doing this. So can you just tell us a little bit about why you've started to do this and what the effects have been?
Okay, well, we're going to actually focus rather than on ESG on climate change. So it's a good example of applying intellectual capital to the big issue of climate change. So as many of you are aware, the Mercer team has been a somewhat relentless advocate for ESG and increasingly over those years climate change since 2004. And so in the last 8 years, we have developed modelling and scenario analysis tools for clients to use to look at their exposure to climate change risks and opportunities. So we started our work back around 2009-10, and CalSTRS was one of our wonderful partners in this work. And we have continued with that work for the last 8 years. And essentially what it does is to take strategic asset allocation and to allow client funds to analyse their exposure to climate change risks and opportunities through scenarios. And so it aligns very nicely with the work that the task force is now asking us all to begin to report against. And so the current work that we're doing, we've worked with Cambridge Econometrics. We have a new generation piece of work that we're doing, and we've extended the work out in terms of physical damages because many of our clients have become really interested in the way the task force recommendations ask funds to frame up around transition risk and also the physical damages. So the new work that Mercer has done out of this trajectory of 8 years is to focus on the physical damages, but also to look at the short-term risk. So as part of the work that we're doing, as a result of collaboration with our clients, we've developed a 1-year stress test part of the model, which can stress the model to look at where there might be shocks, policy shock, some sort of sudden valuation change, or the impact of physical damages on the client portfolio. So I would say that one of the drivers of this work, why has Mercer put so much time and resource and invested so heavily into applying this type of work in terms of asset allocation to climate change, is because We are both advocates for this work. We see it as a material and systemic risk for all investors, and as does the task force. And we also have worked very closely over that 8-year period in a way that we think is contemporary. It requires working together. So, for example, the way that we've developed this climate change work has been to work with groups of asset owners. So most of the thinking, the choice of scenarios were developed with the asset owner, and we also worked with NGOs, have had global advisory boards, industry leaders, and so on. And so collaboration is key. And from the very beginning, in this particular part of the ESG world work, but with a focus on climate change, we've always worked in a collaborative way with academics, with researchers. We've had core NGO partners, IFC, World Bank, public and government partners as well. So we think that collaboration is very important to how to work from the beginning, which starts with governance. So we start with, what are your investment beliefs? Are you articulating ESG and climate in your investment beliefs? How does that then drive your policy? And are those beliefs really set out in your policy? Then the policy should drive the process. Where in your interactions with your managers and your agents are you expressing your beliefs, and in detail providing the assurance that that's flowing through in your actual process? And then finally, the final part is the portfolio. How is that actually being put to work in the portfolio? So the climate change work is very much about guiding clients and funds through a decision-making process. It's not the numbers and the answer so much as providing the fiduciary process and commitment to understanding these risks and opportunities better. And with that, so that I don't monologue for too long, I'll hand over to Brian to perhaps talk a little bit about how you have used this work and what you think some of the, the challenges and the benefits have been.
Sure. So maybe a little bit of background. I think it was the mid-2000s. The CalSTRS board directed staff to make climate change risk one of our priorities. And since that point to today, climate change remains, I would argue, where we probably allocate most of our resources in terms of ESG risk management. And over the years, I think we've done a lot in terms of policy integration, process integration, integrating climate change into our manager evaluations, into our manager due diligence, manager engagements. We've integrated it into our corporate engagement, how we engage with regulators, policymakers. Investments, we've developed the investments across asset classes, but the one area where we've probably not had as much resources to is around asset allocation. And so certainly when Mercer came to us in 2010, it was very intriguing, and we wanted to support it, and we did. And we were happy with the outcome, or wouldn't have supported and been a partner in 2015. And we continue to support Mercer, and we're part of the Future Makers group, continue to look at climate change, asset allocation, scenario analysis. I think from our perspective, a lot of what we do is trying to raise awareness. So I think for maybe a high level, that Mercer, and I would argue one of the few consultants, is really looking at climate change and its potential impacts on asset allocation. We wanted to support that because we want to get, expand thought around climate change and how, investors, asset owners can be thinking about climate change. So that was a success. In terms of the takeaways from the study, it's hard to. One of the recommendations from the most recent 2015 was that we're very heavily public equity indexed, and one was that we should consider shifting towards a lower carbon strategy. Now, the study that was presented to our board, and I can't necessarily say it was causation, but the CalSTRS board did subsequent to that, make a commitment to invest $2.5 billion in a low carbon index. I think where we're using it the most right now is, one of the things that resonated most with me was sort of the risk factors. I guess it was the trip
the
factors,
trip
that,
yeah.
that is technology, resources, impacts, and policy. And trying to sort of understand, okay, how are policy changes, what's going on in technology, resource implications, et cetera, and looking at that, and through that trying to decide, okay, which one of the pathways, which one of the scenarios might we be most likely heading down, and then how can we be better positioning the portfolio in response to that?
Okay, we've got 1 minute left for this case study, but I want to ask one question of Helga, and that's around fees. And so there's an argument that says that climate change in asset allocation and scenario modeling is difficult, it's expensive, we need to pay for it if that's what we want. There's another argument that says that Mercer has a commitment to climate change that's well known within this group, and if they believe that climate change is a financially material factor, shouldn't that be part of their standard service delivery for all clients? So Helga, can I ask you just to comment briefly on fees, and then we're going to go over to audience questions. Thank you.
Yeah, Mercer does a lot of education and awareness raising, obviously, and our soon-to-be released report will be the third of the public reports where we've shared and we believe have contributed quite significantly to asset allocation. So that's been over those last 8 years. And so, for example, Mercer provides all of its clients with intellectual capital updates quarterly, which includes ESG and climate change. We have global investment forums where ESG and climate change are always on the agenda. Stewardship is absolutely core. We have sustainability allocations in all Mercer reference portfolios so that all Mercer clients have exposure to that. We provide, without fees, ESG and climate change related education and materials for boards in presentations. The field consultants take this information out. However, for example, where we are doing very detailed deep dive work, such as with taking a client portfolio and undertaking this shock analysis, which is part of our new piece of next generation work that we've been doing with Cambridge Econometrics, and also the scenario modelling, looking at the way in which a portfolio responds to 2, 3 and 4 degree scenarios, taking that capital allocation and then providing advice around what can be done with those findings. We do charge fees for that, and we believe that that's because it is an enormous investment. I mean, it's been 8 years and a few bodies littered along the road and many lost weekends and nights gone, and it's amazing that I'm still standing up in this direction and breathing at the minute. So there is a sort of a commercial dimension that we just feel the value is, it's very detailed, it's enormous investment of intellectual capital, time and money, and we feel that there is real value there and it's reasonable. So it's sort of a combination approach.
Okay, excellent. Thank you both very much. Can I get a sense of who wants to ask a question? I'm going to ask our 3 consultants to come up and join me. Thank you, Brian, if you could take a seat.
Thanks a lot, Brian.
There's a gentleman in the middle here, Mike and Mark and Sarah. Yeah, yes, in the middle, please.
Hi, Sam Adams with Verd Asset Management. Helga, just a question on how you think you're doing. How many of your clients are taking up these services, investing on a sustainable basis now? And are you doing a good job, a poor job? Are you doing great? And is that better than everybody else?
You tell me.
Or not?
Okay, we're going to take a few questions. Well, that's one for Helga. Is there any other questions? Yes, please. And just introduce yourself as well.
Mike Clark, our advisory. This is going to sound a bit like a setup, given your reference, but I need to assure the room that it's not. You referred to the PIRI's desire that ESG integration got integrated. So I think my question is certainly initially for Meredith. If I look across the manager recommendations, I get this nice large recommendation ranking at the top and a subsequently ESG box at the bottom. Do you have a business goal in X years from now the little one will fall off the page and the ESG rating will be integrated, and if there is a goal, how many years is X?
Okay, thank you. Sarah? And then there's a question here.
Yes, Sarah Cleveland, independent consultant. I'm curious in terms of
Can you put the microphone closer?
I'm curious in terms of talking directly to the asset owner trustees, the consultants. As being in my history as an investment consultant, we never talked about companies. And it just seems that with ESG, that you can't sort of quote unquote do ESG without looking at companies. So what are you thinking, what are you seeing in terms of bringing that to the quarterly meetings and discussing just the ESG evaluations with trustees?
Thank you. I'm going to ask Daniel to reply to that, and if we can take one last question here, and then we'll come to our consultants.
Thanks very much. It's Verity Chager with BlackRock, and I have a question for all three consultants. How much can you use the PRI reports to evaluate managers on ESG integration, and how much do you have to start from scratch because it's not the right stuff you need in there?
Okay, great, thank you. We'll go to Helga first, the question on how you're doing. Hopefully well. And
Feeling
if you
a
could
little
also
bit
answer
bleary-eyed.
Verity's question too.
Too many San Francisco cocktails. Yes, I don't think the consultant can take the credit for the decisions fully that asset owners make. So we're obviously an advisor. We try to assist with implementation, obviously. But there's sometimes other reasons and variables at play. So in terms of, I'm suspecting the question behind your question might be, how well do you go from making a recommendation and seeing it implemented, which is something which makes a difference or moves the dial. I think that the progress that we're seeing is quite considerable in recent times, and I myself have been banging away in the space for a very long time, and so I think the translation is getting faster and faster, but what it does need is it needs leadership within the consultant firm itself, and the consultant firm itself has to do its own work and have its own house in order as best it can. And then it also requires fiduciary leadership within the asset owner as well. So I think once you have those two things fully working, then the decision making and the implementation and progress that we're going to see is getting faster and faster. But I think that there's a long way to go, and there's plenty of work to do for all of us, but we're all part of it. Okay. I really don't think that the consultant alone can convert and succeed in making every investor fully work on climate change and fully capture the risks and opportunities. That's why we follow the collaborative model. We really need to work on this together, all of us that are here.
So I agree with that, but I think there is an information asymmetry here and a resource issue where consultants have far more resources than the clients that they're advising, and sometimes there needs to be the leadership from the consultants to support their clients in that process. Let's go to Meredith now on the ESG ratings. Mike's question, please.
Assuming I remember it. So I think the question was, right now we have a number, and what are we doing to get something more than a number and to integrate everything together? And the answer to that is, it is a process. So we started out, we are giving granular ratings to all of our buy-rated equity and fixed income strategy managers first. We're rolling out a rating system for real estate and private equity later this year, and then we will have all of the different asset classes taken care of by the end of next year. And there's a method to that. If you look at the way that most investors are expressing their ESG, a lot of them are starting from the long-only space, and so we wanted to start from a place that had the most usefulness of the data. Now, one of the reasons why we went with a simple rating system, it's a simple 1 to 4, just like we use on funds for strategy issues, is because our clients are familiar with it. The other reason is that it's very easy to include on reports, and one of the things we're doing is we're including those ratings on every single report that goes out to every single investor, whether they want it or not. And we feel like that's really important because that way we can actually start to have a conversation with a lot of these investors about what does this mean? Why does this manager have a 1? It says here that 1 is bad. what is this, what is this going to mean to my portfolio? By starting out slowly, we're able to actually move the conversation along, we find. We also report back to the managers as to what rating they got. So they ask questions. If they're a 1 or a 2, how do we get to be a 3 or a 4? And so that helps to move things along. But in terms of what we're planning on doing aside from that, the reports at this moment have standardized rating and standardized comments. We'll be building out more specific comments that go with every single manager so you know exactly why they scored what they did. We're going to be having portfolio snapshots with underlying holdings that show the tilts towards carbon, towards other areas that may be problematic from an ESG perspective, what's your exposure to that, and we'll continue from there.
Okay, thank you. And Scott, I'm going to ask you if you've got any perceptions on the differences between how consultants are rating your ESG capabilities, or some doing it better than others. What do you think of that answer? I'm just going to share an announcement that Aon and the PRA Academy, if you haven't had a chance to drop by the PRA Academy stand, please do so, have agreed business terms, that's the technical legal language, to provide ESG training to over 500 of Aon's front office client-facing field consultants in order to support them in understanding what ESG and responsible investment is. Scott, who's microphone number 5 for the gentleman at the back, can you just tell us a little bit about differences in consultants rating you?
Yeah, obviously Aon and Mercer are way out in front. No, I don't know. There is a big difference. I think people are following a little bit different processes, but I think one of the most important things, and we're anxious to have consultants probe deeper into sustainability and ESG. We'd like to see it a deeper section on every RFP that's out there, so we get to the point where it's always a question. Even if a client says up front, I don't care about sustainability, it still should be something that's important in the analysis from the consultant. There needs to be a section in every RFP dealing with that, in our opinion. So we're not there yet, and obviously some consultants are out in front on that issue.
And so perhaps a takeaway for asset managers is that they can help give advice back to the consultants on the quality of due diligence on their ESG capabilities. Dan, we're going to come to you on the question around companies and also Verity's question, please, on PRI reporting.
Yeah, okay, well, why don't I just go, I don't want to seem like the third wheel, but we also at Wilshire have included ESG questions at a due diligence questionnaire and are going around rating managers. But I will say just on that, and I absolutely take Meredith's points, let's not remember who's filling in these due diligence questionnaires at the asset manager. And quite often we do find a disconnect when we're coming to interview the portfolio manager and they're like, that's not what I signed up to. That's not what I do. So these kind of face-to-face interviews with the portfolio manager and the analysts are what consultants do well, rather than the PR spin that perhaps the RFP team or whoever's filling in the due diligence questionnaire in that. So make sure that gets socialized, those ESG questions get socialized amongst the PMs. If I understood Sarah's question correctly, it's about consultants having what's consultants' role in terms of presenting sort of corporate case studies and having grasp of sort of security level sort of information regarding ESG practices. I think clearly, we're not the stock pickers in this case, but I do think we do have a role where I've struggled a little bit with this. I think our role is to consolidate to a certain extent some of the, if we can get it, ESG portfolio information that managers are going to be providing to their end client, because when I've asked for this information to be provided to the end client on sort of ESG outliers or carbon footprinting, you'll get, sorry to use PIMCO as an example, or BlackRock as an example, providing a carbon footprint using a completely different methodology to each other. So I do think we do have a role in terms of sort of standardizing some of that presentation of materials in order to help the investment committee to understand what to do with it and how to engage the portfolio manager. So I think we've got a role there. Verity's question, and open it up to these two, PRI assessments. Clearly, responsible investor are trying to go around to get transparency on managers' scores who don't just have an A or an A plus. I get a flurry of emails telling me when a manager's got an A or A plus, and they don't tell me when they don't have an A or A plus. So I just have to assume, if they haven't told me anything, they do not have an A or an A plus. But where we're at now is that, and it's sort of public information for one of our public plan clients. I went into, and I appeal to others to do this, the PRI database, because it's not just about the scores, but it's about the actual responses to each individual question. And so we often get asked the question, presumably the two of you do as well, about peer reviewing asset owner practices. So I went into the PRI database, selected a group of US asset owner public plans above 10 billion, and went through some sort of differences in approaches. Why does CalSTRS choose to vote its proxies in-house, whereas other, perhaps smaller US public plans outsource it to their managers? And so, and trying to understand the difference in approaches. So it's not so much the assessment score, but the actual database that is on the website is a useful repository.
Okay. Thank you. I've got time for one more question if we're quick. Lynn, is it at the back in the middle? Yes, please. We can.
Just about.
Great, thank you. I'm going to ask Meredith to answer that, and then I need to conclude to get you to your next meeting. Thank you.
He's a harsh taskmaster. So obviously the corporate behavior of the asset manager is a critical thing, and it's particularly critical in the age of Me Too and where sexual harassment and sexual harassment litigation can not only be an issue for governance, it can not only be an issue for social aspects, it just can be a tremendous business risk. And so we are certainly looking at those types of things. We have some initiatives around trying to gather more information about the corporate social responsibility of the asset managers that we work with above and beyond their portfolio. And obviously our goal would be to work with people who have both well-integrated ESG portfolios and who have an organization that exhibits good CSR.
Great, thank you. Now, if you've found this session interesting and you want to learn more about what we're doing with investment consultants, you can reach for your phones now and email policy@unpri.org, and we're going to keep you updated with that. If you're an asset manager, why not next week work with your asset consultant communication teams to understand how they communicate your ESG capabilities? If you're an asset owner, have you asked your asset consultant what their investment beliefs are? If their investment beliefs are not prominent, ask them why they're not. If they commit to ESG, ask them to which clients they commit to. And if they don't commit to all, ask them why they don't commit to all. We're preparing guidance for asset owners on the selection, appointment, and monitoring of asset consultants. If you're interested in that, email that same email address too, and we can share that with you when it's ready. And if you're an investment consultant, a very simple message is don't tell clients what they want to know, tell clients what they need to know. So thank you very much. Thank our panelists. And on to the next session.